All right, welcome back, everyone, to another episode of Give Me Some Truth International Edition. I'm Sil Michelin. I'm joined in the booth today by Keith Poniwaz and Stan Farmer. And I think the topic we wanted to cover today will be how much international exposure should I have in my portfolio? That's the general theme for our discussion. So I guess to get started, first of all, we can't tell you exactly how much international exposure you specifically need to have as an individual viewer because that depends on a number of different factors. So always take into account your entire financial situation. But we can share some, general guidelines, and we can also share some of, the ideas that we incorporate in our own decision making in the hope that maybe this will be useful to some of our viewers. So
I really like this introduction today from Sil. It's
thank you. Thank you.
Masterpiece theater.
It is.
Yeah.
It's
very erudite. So
thank you.
Stan, it's up to you and I to lower the whole level of the discourse.
Well, I challenge accepted. I think that if you look at the history of the stock market, the broader stock market, not the S&P 500, not the Dow, which is 30 stupid stocks that they change constantly, or the NASDAQ. If you look at the broader global stock market, right? The U.S. is the big dog, right? I mean, and it always has been. Although Japan tried to catch us, I think in the 80s. How did that end? Not well. But if you look at how investors behave on the whole, I'm guessing that the number of Patriot portfolios has never been higher either, right? Where people have eschewed owning. I'm starting to still's rubbing off on me. If you look at performance of 401ks, like the Dalbar study that was done in the 80s and 90s, right? The S&P 500 was up 15%, and the average 401k was up 2.9%. And just real quickly, the reason behind that is obvious. People chase returns, right? The 401k menu will give you, the trailing returns of every investment. So every retail investor, every person, the home gamers, the do-it-yourselfers, right? I wouldn't say every, but on average, chasing returns led to not just suboptimal outcomes, but horrible outcomes.
Right.
And right now, chasing returns, well, that 401k is going to be loaded up with Uncle Sam stocks, right?
Well, and it's not even a case of chasing returns, because if you look at the past 15 years of performance, U.S. equities have just done way better than everything else. And it's not even close. If you look at the average annualized return of the U.S. market, it's somewhere between 12 and 13%, depending on what day of the week we're talking and what the market has done. And if you look at a basket of global markets, it's somewhere between 6 and 7%.
Right.
Now, there are a couple.
So why would you ever own this basket of stocks, Keith?
Well, there are a couple of things that, first of all, I would say have negatively impacted, that foreign basket. And one of those things is over the past 15 years, we've seen a historically strong dollar, and it continues to climb. And for a long period of time, particularly in the wake of 2008, 2009, and also kind of right around, the pandemic, the U.S. was, the safe store of value, which kind of promoted people moving money into the U.S. dollar. For a long time as well, we've seen the U.S. interest rate be more competitive, we'll say, better, you could say, than other global interest rates. So one of the headwinds that's gone into global markets over the past 15 years that accounts for some of that gap is a certain bit of currency.
The currency effect.
Yeah. Mm-hmm. But what I'll say is, even if you're not chasing returns at this point, just because of that outperformance, U.S. markets have taken on an overwhelming part of your portfolio, even if you started with the best intentions 10, 15 years ago to be globally diversified.
Right. And so let's say if you wanted to not try to trade in and out of positions and you didn't want to take, tactical views about, the way the economy is going in different parts of the world, and you just wanted to be a good, responsible, diversified investor with a global portfolio, wanting to own stocks from all over the world, right? So ideally, if you are thinking as like an asset allocator, as someone who tries to use diversification to reduce risk, conceptually, you would want to own stocks in every country around the world. Actually, if you really want to push this reasoning really far, you would want to own every stock in every country around the world. You would want to own everything, right? Because if it gives you a chance to diversify further, why not own it? So in practice, it may not be possible to own every stock in every country around the world.
Well, and I would also say in practice, at some point, the amount of diversification and the actual benefits to your portfolio reduce.
It starts to reduce.
Returns.
Absolutely. Yeah. But nonetheless, you could use a proxy like a very well diversified index as a benchmark to try to achieve this really broad level of diversification. And so we've got some data on this topic that we will try to display for our viewers on the screen. And the idea is to look at a benchmark that is very global, like the MSCI All Country World, as just one example.
That includes the U.S., that includes everything, correct?
That's correct. So that's a benchmark that aims to really represent the entire global stock market. So we're talking about U.S., we're talking about developed non-US, so Europe, developed Asia,
right,
and also emerging markets. And it's market cap weighted, and it owns thousands of different underlying stocks. So
by market cap weighted, you mean the more money is in that market, the more it's represented in
exactly. The larger the company, the larger its representation
right. So
in the index.
You NVIDIA lovers, still get plenty of NVIDIA.
Absolutely. Right? Absolutely.
Get your Apple.
And so, an index like the MSCI All Country World, and by the way, there are other indices. I think there's a Morningstar index that does substantially the same thing, are good ways to have a general idea of what a broadly diversified international portfolio should look like. And after this long era of U.S. outperformance that we just had, we're looking at the U.S. based on the data that I have here, representing about 66-67% of global stock markets. The data I have here has North America. Well, actually, the data I have here is 62.6% to the U.S. That's from 2023. It's probably gone up a little bit since. But that gives you a sense for what a market neutral, broad, diversified allocation would look like. So it kind of means in a way that if you have any more than 60-ish% allocated to the US, you're taking an active tactical position, and you're over allocating to the US, which may be very good or may be very bad. It depends. But it's true to your point earlier, Stan, that we see portfolios sometimes where 98.6% is allocated to the US, and people don't necessarily realize that this is good diversification if you own a lot of US companies, but there's a lot more you could do to add diversification to your portfolio. And likewise, there's people living in Europe who may have some sort of employer pension that has the same level of kind of home bias and would have, 60% allocated to European equities. That's even more skewed because European equities are, at the end of the day, a relatively small part of the market as a whole, and certainly much
in between 25-30%,
much less,
less than that even. So really, I think this idea of looking at a broad diversified index and using that as your starting point, and then start making adjustment from it, is one way that investors can think about how to approach international diversification.
Right. So what would you say to the argument that, and Keith, feel, obviously either of you, what do you guys say to the argument that you sometimes, hear the gurus make that, when the U.S. coughs, the world catches a cold kind of, arguments that the U.S.'s leadership, has somehow made it, unreasonable to take this global approach to your investing?
Well, I was going to say one thing that happens is that even when the U.S. gets a cold, and maybe it's the socialized medicine in Europe, the stock market indices there tend to perform less poorly than in the U.S. And part of that has to do with how they're composed. Generally, if you look at a European index, it would have more of a value tilt than you might have in a U.S. index, especially now if you look at the
U.S.
U.S.
It's never been more true, probably.
Yeah,
right?
I was going to say, especially now that you look at the kind of FANG stocks dominating the U.S.
Right.
S&P 500 large cap space. So what happens in a lot of these cases, 2022 being a very good case, and this isn't necessarily a thrilling thing to tell people, but your portfolio internationally is going to hold up generally better in a downturn in a negative market like we saw in 2022 in particular, where you saw, because those companies are driven less by high multiples, that is to say, a lot of U.S. large cap stocks are now trading at 25, 26%, and the valuation of the stock is really driven on, okay, they produce this amount of dividend, they produce this amount of growth, and it's much more predictable and is less susceptible to downturns. It will keep going at those rates
Absolutely.
year in, year out.
So there can be correlation.
Yeah.
The markets can all be moving in the same direction, and yet diversification has a benefit.
You're going to lose less. It will move in the same direction, but not as severely in a lot of cases.
Absolutely. And another topic that I wanted to touch on, because I feel like a lot of people are probably familiar with diversification as it relates to equities, but we can have a very similar discussion that relates to bonds, to the fixed income side of your allocation. We have some really interesting data on that topic as well. The global bond market is a little harder to navigate because, like, the MSCI All Country World on the equity side looks at investable stocks that have a certain threshold for liquidity, for example. In the bond space, there are bonds that are very thinly traded, not very liquid, or in currencies that are not deliverable and things like that. So it's a little harder to relate the overall universe of outstanding debt around the world with what you can actually trade.
Well, and then one of the other things that should come up as well is that within the bond market, you have, dollar bonds, right?
Exactly.
Bonds traded in USD, you have bonds traded in euro, you have bonds traded in yen.
Yeah.
And a lot of foreign bonds are actually issued in USD in order
Correct.
to gain kind of exposure to really the biggest market in the
Correct.
world.
China?
Yeah.
But it's also true that when we talk about home bias, it's true in the equity space, but it's perhaps even more pronounced in fixed income, because most people, when it comes to allocating to bonds, they will look at, maybe just municipals and treasuries and some corporate bonds, and it's all very US centric. But if you look at, in the spirit of just looking at the global market, the US is actually an even smaller portion of the bond market than it is of the equity market. And if you look at the global total outstanding debt, I think that adds up to about $133 trillion or so, based on
here, trillion there. You're pretty soon you're talking
exactly
about real
right. I think the U.S. represents, according to our data here, about 40% ish of the market as a whole. Everything else is really happening outside the U.S., right, including countries like China, Japan, United Kingdom, France. So if you look at the global bond market, there's in a way even more of a case for saying, hey, we really need to diversify further and look abroad. And that's where it's a little bit more challenging, because I feel like there are fewer products available. But when it comes to issues of like currency diversification. I think that's also a very important topic for our viewers.
Yeah, I mean, because if you look at like some of the most popular products for international bond investing, many of them, I'm not going to dare say most, but perhaps most, but many at least, it's fair to say, hedge their currency exposures, right? So part of the diversification with stocks is currency related, right? Mm-hmm. And then you go over to the bond side, and that diversification can be there, but there's a high probability that if you aren't reading the fine print, that you're purchasing a product that has taken away that element of the diversification.
Absolutely.
Well, and in the bond area, I mean, you can look at correlation matrices, and depending on your situation, a U.S. dollar bond hedge may make sense, right? Let's be clear here. But particularly if you're an investor thinking about, you live abroad or maybe moving abroad and you don't have exposure to, sources of steady income in your local currency, that non-U.S. dollar hedge is something to bear in mind. Part of the reason as well you've seen so much go into USD hedged performance is because it's outperformed.
Right.
Both on the equity end, you can look at there are equity funds that are USD hedged for Europe, for wherever, and they've outperformed. Same on the bond side, right?
Right.
And so part of it is thinking about what need this is fulfilling in your portfolio.
Exactly.
And what you're trying to do, because international bonds can serve a real purpose, even if you're in the U.S., even if you're not really into getting into foreign currency, in directly or, having that additional fluctuation, because it does lead to additional volatility in the portfolio. But it can be, because you can see divergence between what the rest of the world is doing in terms of bond yields and the U.S., and it also is a way of picking up maybe some extra yield than you might not be getting in the
Absolutely. US. All right, so we're out of time for today. So I hope you enjoyed the discussion, and I will get reprimanded if I don't remind people to like, subscribe. What is it? Smash the like button.
Subscribe to our channel if you're interested in this kind of content and would like to get notifications when new videos are available on YouTube. And if feel free to leave comments on
this is I'm waiting for him to go
and yes, smash
there it is. There it is. He said it.
I said it.
So thanks everyone, and we'll see you next time for another episode of Give Me Some Truth International.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.